let's just start off today. I just want to just a few admin related items. Normally we're supposed to admin at the end, but everyone runs away so quickly. So yeah. Anyway, so there's no lecture tomorrow. Just got to remember that. So we're not having a lecture tomorrow. This is going to be and the reason why we're not having a lecture tomorrow is because I want you guys to actually go ahead and study for the test, which is happening Monday in the Chancellor's building at 5:30 in the evening. So that's why you're not having a lecture. So use the time wisely. Make sure that you study hard for the test on Monday. And yeah, so just make sure that you do that. The other thing is test 3. So test 3 obviously looms large immediately after test 2. So test 2 is taking place on Monday. And then in about 3 weeks' time, we sit for test 3. And remember, I told you that the format of test 3 will be slightly different to test 1 and 2. It's going to be more online based, very similar to your online homeworks. And so what I've done is to help you practice and to help you get a feel for the test and how it'll work, is I've created a test 3 preparation content area on ClickUp. Now, I was planning to release that content area on Wednesday, but then I thought to myself, what's going to happen is there's going to be a large amount of students, obviously, that will be super confused, right? Because they're going to be preparing for test 2, and then they're going to see like online stuff for test 3, and it's going to confuse them. So what I then said is, I think the best thing would be for me to release it immediately after the test on Monday. So Tuesday morning, you start prepping for test 2, right? Or you can if you want to. So that's what we'll do. So you'll get on Tuesday next week, I'll release the practice for test 3, and then you can play around with it. And it's not for marks, but it will be online. It will look like a test, but it's not for marks. What I've done is I've taken some of the old past papers which you already have, and I've converted it into like this online thing. And then the other important thing is that I expect you to do the old past papers as you would normally, and then I expect you to come and play around online and see what the differences are and how it will and how the system will work, right? Just so that you're familiar before test 3, right? And so then I expect a lot of questions and that sort of stuff about the format and how it will all work after that, okay? So that's test 3. Yeah, so test 3 is not going to be online. It's going to be electronic on campus. So you will have to come to campus, but you will complete it on a computer, right? We'll have it in the labs, computer labs, and you will complete it on a computer, but it will be electronic. So that's the computer part, and it's on campus, right? So you'll be invigilated by our people, by the peeps who will invigilate you. Okay. Cool. Let's continue our discussion about income tax. Guys, so far we've had 4 lectures of income tax, right? And so this is going to be our recap slide. So if you don't see the slides on the slides that you downloaded, then please go ahead and download them again from ClickUp, because I did make some changes and then I uploaded it on ClickUp this morning. So you can go and download these slides with the boxes and the funny, colorful things, so that you have the same stuff I'm looking at. Okay, so this is found on page 266 of your textbook, right? Super important. It is our summary, right? And what you're going to see on this page is it basically summarizes all we've been chatting about and all we've been talking about in the last 4 lectures, right? And so it's basically our tax computation or our calculation of taxable profits, right? We call it, in the past, we used to call it a tax computation, and that's why you'll see sometimes I'll switch between the word calculation for taxable income to tax comp, right? Which is short for tax computation. Right. So Anyway, so let's just start recapping. Let's just think about what we did, right? And we said the principle in this section is we want to move from accounting profit or profit before tax to taxable profit so that we can correctly estimate our income tax expense, right? That's the key. We want to estimate our income tax expense, and in order to do that, we need to move from accounting profit to taxable profit. Right, and so we said there are two types of differences. The first is permanent, right? And so that's what we were talking about first up at the beginning, right? And so we started off here with temporary differences, and we said, okay, there's two types of temporary differences. We've got our exempt income, and what do we do with our exempt income? Do we add or subtract? Type it out in the chat for me. We've got our exempt income, and we said there are two types of exempt income. The first is dividends. That's it. Yes, we subtract. The first is dividends income. As long as it's from a South African company, we need to subtract it from accounting profit to make the profit smaller because it's exempt. And then the next one we spoke about was the exempt portion. Yeah, the exempt portion of capital profits, right? And so how did we calculate that? Right, and remember that's the 20% that we are talking about, the 20% that we don't tax. So we said, okay, the first thing we need to do is we need to undo the accounting profit, right? The accounting taxable profit, and we calculate that by taking the selling price minus the cost price, right? And that gives us the accounting profit that we would have included in profit before tax. So we undo that by subtracting it. We then need to add back the taxable capital gain. How do we calculate that? We say selling price minus cost price, or another word for cost price, the tax word for cost price is called base cost. So selling price minus base cost multiplied by 80, and that will give us the taxable portion. Now, the product of those two numbers is going to be the exempt capital profit. Right, so that's an exempt income. We need to subtract it. So those were the two exempt incomes that we spoke about. The next permanent difference we spoke about was non-deductible expenses. Right? What do we do with non-deductible expenses? Pop it in the chat. Do we add or subtract? So non-deductible expenses. Some examples of non-deductible expenses. We spoke about fines. We spoke about interest charged by SARS. We spoke about penalties that might be charged by SARS. We also spoke about donations that are made to a profit entity or donations that are made to an entity that is not a not-for-profit entity, right? So when we're donating to a profit entity, what the government then says is, listen, you're actually giving a gift, right? So I'm not going to allow you to use that as a deduction. You need to add it back, right? And so we add back these non-deductible expenses. Okay, and those were the permanent differences that we came across, right? And so just remember here in our template here, in our cheat sheet, let's call this the cheat sheet, we've only got fines, but remember we also got interest because of SARS, or interest charged by SARS and penalties charged by SARS, etc., right? And then also donations expense. Right, so that was the permanent differences. Then we started chatting about temporary differences, guys. And remember, the difference between permanent and temporary differences is that with permanent differences, they never go away. So there will always be a difference between accounting profit and taxable profit, no matter how many years we look at. That's a permanent difference. The temporary difference, they disappear over time. Right, and so we're going to start in the blue block. So pull your eyes down here to the bottom of the slide. We're going to start in the blue block, and basically we said the first type of differences that we can have are accrual-based differences. Accrual-based differences, and that's because accountants use the accrual method. The taxman uses a hybrid method. So a little bit of accrual and a little bit of cash, right? And so as a result of that difference in treatment, we get temporary differences. So first one we spoke about was income received in advance. And so from the accounting perspective, we don't want to include it in accounting profit, right? Because we haven't earned the income, right? But the taxman says, no, I want you to include it. You must include it and so that I can tax you on it, right? And so what we then do is we include it. But there's a risk now that when we include that balance, right, that closing balance of income received in advance, there's a risk that there's a portion of that closing balance that in a prior year was still there. So it was there in the opening balance. So let's say we included it last year and then we include it again this year. So now we're being taxed twice on the same amount. So in order to get around that and to get away from being taxed twice, what we then do is we add the closing balance, but we subtract the opening balance, right, of income received in advance. That's because we include the income received in advance, but there might be a portion that was included last year. So to eliminate that, to make sure that we're not taxing ourselves twice, we add the closing balance, but we subtract the opening balance, right? That's income received in advance. Then we spoke about prepayments. We said prepayment similarly, or prepaid expenses. Similarly, what can happen is the taxman will want to include it in the year that it's paid, right? And we will only include it in the year that it is earned. Yeah. So then what we need to do is when we trying to move from accounting profit to taxable profit, we then say, okay, now I can subtract this prepayment because the taxman allows me to subtract it. So I subtract the closing balance, but then very similar story, there might be a prepayment that we're subtracting in year 2 that we had already subtracted in year 1. So to avoid that, we then now need to add back the opening balance. So we subtract the closing balance, add the opening balance for prepayments. Yeah, and then remember, guys, when we were talking about prepayments, we spoke about that special allowance. What allowance did we call it? We called it the allowance for expected credit losses, right? And so with the allowance for expected credit losses, we said what we need to do is we need to undo the accounting movement, right? The movement that went through in the current year. And then we treat the remainder of the balances, we treat them as a prepaid expense, right? And so we subtract the closing balance, but we add in the opening balance, right? And so that was that special, remember that special allowance, right? Everyone remembers that. And then we spoke about provisions, and we said with provisions, the problem is the taxman says, listen, I don't trust your estimate, and therefore you cannot deduct it. Now, when we were calculating accounting profit, we would have deducted it, yeah? So what we do is we add it back, and so we add back the closing balance. But again, there's a risk that there's something in the closing balance that we had already added back last year. So in order to get around that, we add the closing balance, but we subtract the opening balance, right? And so that those types of differences were accrual. We call them accrual differences, right? They're differences because we use the accrual system. Taxman, he uses the hybrid system. Then in the last lecture, we spoke about depreciable assets, right? And we said there's different rates of depreciation. So we have depreciation maybe at a specific rate, and then the taxman has depreciation at a different rate. So because there's differences in rates, and remember, we gave the taxman's depreciation, we gave it a name, and we called it wear and tear. Right, so it's a wear and tear allowance. And remember, this is where the taxman changes all the names of everything, right? So what we need to do now with the depreciable asset is we need to remove, right? We need to remove the accounting treatment and replace it with the tax treatment, and that meets our principle of moving closer or correctly estimating the tax expense, right? And so we remove the accounting treatment for a depreciable asset. What does that mean? It means because we deducted depreciation when we were calculating profit, we now need to add depreciation back. So we're undoing what we previously did. And then in order to replace it with the tax treatment, we then subtract the wear and tear allowance. Okay, so that's what we do with depreciation. Now, when we sell an asset, remember we would have dealt with the capital profit in the permanent differences. So now we need to address the non-capital profit. So the amount under cost price, right? So the selling price that arrives under cost price. And so how do we calculate non-capital profit? We say, okay, what is the cost price? And then we limit it. I mean, what is the selling price? And then we limit it to the cost price, and we subtract the carrying amount, which we would have calculated for accounting purposes, right? And so that is going to be the profit. Now, if we want to undo that, because we added it to profit at the top, we need to undo it, and in order to do that, we subtract. All right, we subtract the non-capital profit, and then we have to now replace it with the tax treatment. And the taxman, he doesn't call it a profit on sale of disposal. He instead he calls it a recoupment, right? And so how do we calculate that? So very similarly, we say selling price limited to cost price, and then we subtract the tax base, right? And the tax base is basically another word, or the taxman's word for carrying amount. And then obviously, so we now need to add that recoupment into the taxable profit, because we're replacing the accounting treatment with the tax treatment. Obviously, if we had a loss, we would do the opposite. So we would add the loss on sale of asset to accounting profit, because we had previously subtracted it, and then we would subtract the loss from the taxman's side, and he calls that a scrapping allowance, right? He calls that a scrapping allowance on the sale, right? And so that basically summarizes what we spoke about for the first few lectures. And this template here on page 266 is super important. It's very important that you know when to add and when to less, or when to subtract. That's going to be super important for test 3. So I want to make sure that you learn this very well. Now, does anyone have any questions about the recap, about what we had spoken about so far? Any questions, maybe something you don't understand? Please put your hand up or put your mic on, and just ask your question. Does everybody understand why we add and why we subtract things? If you don't, it's super important that you get it now, right? Because we're at a stage where we're going to move past this and we're going to start to do other stuff. Okay, so it seems like no one has responded, or no one has any questions, so we'll just move on. And then anyway, so that is so that is the tax computation, or the tax income tax calculation that we had studied, right, and that we had learned. And what's that doing is that's trying to calculate taxable income or taxable profits so that we can multiply it by 28%. So this last line here is the line that people sometimes forget, right? So that last line that I've just circled, that you need to take the taxable profits and then multiply it by 28% to get your income tax expense for the year, right? So that's important. Now, you'll remember I left you last time, in the last lecture, we ended off the lecture by talking about assessed losses, right? And we said, okay, so assessed losses is a situation, just like in accounting, when we can make an accounting loss. So what is an accounting loss? An accounting loss is when you have your expenses being more than your income, right? Everyone happy? Your expenses were more than your income, you would have made a loss. So from the tax perspective, you can make a tax loss when you have your allowable deductions, right, which is more than your gross income, right? So if you have your allowable deductions more than your gross income, we call it a tax loss or a taxable loss. And so for us, you got to remember, as the accountant, we can only estimate tax. I can't give you the final amount of tax. The only person that can give you the final amount of tax is the taxman, is SARS. And so if we have a situation where we have estimated that we're going to get a tax loss, and then we send off our tax return to SARS, and SARS agrees with us, right, then we call it an assessed loss. Why do we call it an assessed loss? Because what SARS has done is he's taken my calculation, he's assessed it, right? Assessed it means to test it. He's tested it, he's assessed it, he's looked at it, and he's provided me with what he calls a tax assessment, right? And so his loss agrees with my loss, and only then can we now say, okay, now we have a tax loss. Remember, with the tax loss, the taxman is not going to pay you, right? He's not going to pay you the tax. The tax loss multiplied by the tax rate. He's not going to pay you that amount. That amount is never going to be paid. Instead, what he does is he gives you a type of credit, right? So it's, for example, I don't know if any of you like bought stuff online or whatever, but sometimes when you buy things online and you want to return it, the company will say, listen, we're not going to give you back your money. Instead, we'll give you a credit that you can use on a future purchase. This assessed loss is very similar to that. The taxman gives you a credit that you can use on future profits. Okay. Now, for back to 100 purposes, I will always tell you in the question where if you can use your tax loss or if you can't, right? There are situations where you can't use the tax loss, and your textbook goes into detail about that. But just remember to read the question carefully, and you will know after reading the question whether or not you can use the tax, whether or not you can use the assessed loss. Okay. Any questions? Does everyone remember we chatted about a tax assessed loss last time? So this was the last temporary difference that we dealt with, but we never did an example. Okay, we never chatted about example. So today we're going to do an example on the assessed loss. Okay, so this is example number 10. Let's have a look at what it says. It says J Limited had profit of 5,000 Rand in 2017. That's year one, right? So J Limited had a profit of 5,000 Rand in 2017. But then they had profit of 30,000 Rand in 2018. So that's year two. So year one, 5,000 Rand, year two, 30,000 Rand. Right. It then says that there's a depreciation that we need to take into account of 7,000 Rand per year. However, the wear and tear allowance, right, that we get from the taxman is 15,000 Rand. Now, question for you, you must type this out in the chat. What are you going to do with the depreciation when you're calculating taxable income? Are you going to add or subtract the depreciation? Right? That's it. We're going to add the depreciation back, and we're going to replace it with the wear and tear allowance. So we're going to subtract the wear and tear allowance. Everyone happy? Right? So we're going to subtract the wear and tear allowance. Now let's have a look at what happens in year one in 2017. Right? Let's see what the taxable income in 2017 looks like. Now have a look at this, guys. So we come in, profit for the year is going to be 5,000 Rand. Now, this is what we call accounting profit, right? Profit before taxes, accounting profit. So we have profit for the year, 5,000 Rand. Right. Now, we then add the depreciation and we subtract the wear and tear. Now, notice we're adding a small amount. So we're adding 700, but we're subtracting 15. I mean, we're adding 7,000, but we're subtracting 15,000. So we're subtracting a bigger amount, right? And so as a result of this, when we compute these two amounts, we get a net movement of minus 8,000 Rand, right? So these two amounts, if you add them together, you're going to get a net movement of negative 8,000 Rand. So the problem is we only have profits of 5,000 Rand. So we are going to make a taxable loss of 3,000 Rand. So we say 5 minus 8, 3,000 Rand. Everyone happy, right? Now, the taxman, he's not interested anymore, right? He says, oh, you've made a loss. I'm not interested. Yeah, I'm not going to pay you. And you're going to find out today, he's even going to say, I don't want your money for this year, right? So he's like, whoa, you've made a loss. What you can do is you can use it next year. So there's some good news, right? So let's have a look then. What happens in 2018? So this is year two, right? So what happens in the next year, right? So I've put the two tax comps side by side so that you can see where the numbers are coming from. So again, we start off with 30,000 Rand accounting profit. We then have to add the depreciations. We add depreciation, we subtract wear and tear, right? And that's going to end up giving us a taxable income of 20,000 Rand. Now, this is the important part, right? We're able to carry over that loss from last year to decrease our taxable income. So we came up with taxable income of 22,000. We are then able to decrease it by the 3,000 loss, which we brought forward from last year, the credit that we brought forward from last year, right? And that leaves us with a taxable income for the year of 19,000. Okay, everyone understand? Everyone understand how the mechanics of how the assessed loss gets netted off, right? Now, I've got a question for you. So if we look at year one, if we look at 2017, what do you think your income statement is going to look like? What will our income statement look like in 2017? Now think about this. You're going to have profit before tax of 5,000 Rand, right? In 2017. Happy? Then you're going to have tax expense, but remember you made a loss. And so there isn't any expense, there isn't any tax to be paid in 2017. So you're going to have 5,000 Rand less tax expense, zero, right? Zero tax expense. And then you're going to have profit after tax of 5,000 Rand. So in that situation, in 2017, your profit before tax and your profit after tax is the same. Everyone understand? Yes, so it's going to look like just a straight 5,000 Rand profit. So this is what we're saying. We say, so let's just look at 2017. We've got profit before tax, 5,000, no tax, and then 5,000 again after tax. Okay, but now in 2018, we start off with 30,000 profit before tax, right? This is our income statement, yeah? So we start out with 30,000 profit before tax. We then take the 19. Where did we get this 19,000 from? It's from the previous slide, right? So the 19,000 is the taxable income, right? And notice, so this is the part everyone forgets. We multiply it by 28% by the tax rate. Right, and that gives us 5,320 Rand of tax expense, okay? And that's what we now subtract from our profit, okay? Which then results in a profit after tax of 24,680 Rand. Now remember, in lecture 1, we spoke about the silly shareholder or the stupid shareholder that will calculate how much tax you paid by looking at tax expense and profit before tax. And we said we used to do that in first year ourselves, right? Remember? And so that's, if that shareholder was to do that, he would then say 5,320 divided by 30, right? And then we change that into a percentage. It looks as if we are paying a 17% on tax. Does that make sense? It looks as if we're paying 17% on tax, but in fact we've multiplied it by how much tax, what is the tax rate we've actually applied? We've actually applied 28%. That's our applicable tax rate, but the effective tax rate is 17.73%. Everyone understand so far? Any questions so far for me? Anyone lost? Anyone not understanding what we're speaking about? You have to tell me. Right. Okay. Now I've got another question for you. Right. Look at this 5,320 Rand tax expense. How would we record, what journal entry would we pass for that? What is the journal entry going to be for tax expense? Now, tax expense is what type of account? So we need to say, is it an asset, liability, income, expense, or equity? It's a expense, right? Right, it's an expense. So expenses increase on what side? The debit side, right? So in 2018, we're going to debit income tax expense, right? Because it's a expense, it's increasing. And then, because we're not going to pay the tax immediately when we calculated it, right? So we're going to record this tax, but we're not going to pay it immediately when we calculated it. Instead, we need to create this type of creditor, right? We're going to create this type of creditor, and we're going to call it a current tax payable. Don't ever call it SARS creditor, because that's not right. There's a specific name for it. It's going to be called current tax payable. Oh, there's a question. Let's see. Is it the formula for calculating effective tax? If it is, what is this the formula for calculating effective tax if it is not given? Yes, this is the formula. You take tax tax expense for the year divided by profit before tax. That's the formula. Okay. So back to our story about the journal entry, right? So we have to debit income tax expense, right? So that's what we're doing here. We're debiting income tax expense, right? We all knew that because it was an expense, and then we credit this liability, right? And it's going to be called current tax payable, right? So it's sort of like it's like a SARS creditor. It's because we owe SARS the tax, you see. So we create this sort of creditor for SARS, and we call it current tax payable. Okay, everyone understand the journal entry? Any questions about the journal entry? Right. Obviously, the amount is going to be 5,320. Right. Okay. Cool. Now, I want to revisit example 8. So we did example 8 when we were talking about depreciable assets, and we only were required to do example 8 until 2003, right? So we started off in 2001, and we said, the taxman, he is depreciating, or his wear and tear allowance is actually larger than the depreciation that the accountant is recording. So you'll find accountant was doing 20, the taxman was doing 25. So what that has done is that means that the taxman depreciates the asset faster than the accountant. Makes sense? The taxman depreciates the asset faster than the accountant. So if we fast forward, okay, and we end up in year 5, right, what are we going to do in the tax computation? What are we going to do in the tax computation? We're going to do what to depreciation? We're going to add depreciation back, right? Everyone happy? We're going to add now I'm talking about 2005, guys. So in the last year, we add depreciation back, but then what are we going to subtract? We can't subtract anything. Why can't we subtract anything? Because the asset has been fully wear and teared. It's been fully depreciated. There's nothing left, so we can't subtract wear and tear. Everybody, does that make sense? So in 2005, we're going to add the depreciation, but we're not subtracting any wear and tear. So can you see that in 2005, we're only adding, we're not subtracting. So we are actually going to be paying more tax in 2005. Yes, we're going to be paying more tax in 2005. Now, if we have a look at the difference between the tax base and the carrying amount, what you will see is tax that we should have maybe paid in year 1, 5,000 Rand of tax that we should have maybe paid in year 1, gets delayed. So we delay the tax and we only pay it when? In year 5, right? And so basically in year 1, we delay 5,000. Year 2, another 5,000. So our total amount is 10,000. Year 3, another 5,000. So our total amount is 15,000. And then at the end of year 4, we would have delayed a full 20,000 Rand. And that is the amount that we are going to need to increase our taxable profits by in year 2005. Okay, everybody understand, right? We are delaying the tax. Now, another word for delay is to defer something, right? And so that is the tax that we're going to be talking about now. It's called deferred tax. Any questions? Any questions so far? Right? So deferred tax is tax that we should have paid, right, in a prior year, but it has been deferred to another year, right? So it's been deferred to another year. So in this example, the example with the depreciation, we are paying less tax in year 1, 2, 3, and 4. We're paying less than we should have, but in year 5 we're paying more. So we're deferring that tax. And what is it when you pay something later? Where does the 5,000 Rand come? It's the difference. The 5,000 Rand is the difference between 80 and 75 is 5,000. Between 20 and and 25 obviously is 5,000, and so the balance is different by 5,000. Right. So what does that mean? What does that mean? You're saying to us, oh, I'm supposed to pay this 5,000 rand, but I'm going to pay it at another time. So what is that? Where you're supposed to pay something today, but you're going to pay it at another time or later on. What is that called? That's called a liability. Yes? When you need to pay something in the future, but you should have actually paid it today, it's called a liability. Everyone agree, right? Everyone agree that this is a kind of deferred tax liability, right? It's tax that you should have paid today, but you deferred it, so you created a liability, and you're going to pay it in year 5, right? We can also have a situation. Let's look at, for example, a income received in advance, right? So you guys know, with income received in advance, in year 1 we add the income, right, to our taxable profits, right? So what does it do? It makes the taxable profits bigger. Yes? In year 1, it makes the taxable profits bigger, right? But then in year 2, we then say, I've now earned this income, so I can include it in the accounting profit. You see? Now, we sit with a problem there, where in year 1, we made our taxable profits bigger, and therefore we paid more tax, right? But in year 2, what you're going to see is we're going to subtract the opening balance, right? So we're going to make our tax smaller in year 2. So what's happened with the income received in advance is we've in fact paid too much tax in year 1, right? Everybody, does that make sense to everybody? We've paid too much tax in year 1 with the income received in advance. And when you pay something in advance, what do you call that? You call that, it's like a prepayment. It's like an asset, right? So for income received in advance, we would have a deferred tax asset. So this is the important part. Deferred tax can be an asset or a liability, right? It depends what the deferred tax relates to, right? So does everybody understand why deferred tax can be an asset or a liability? Give me a thumbs up in the chat if you understand. Right. Okay. I was getting worried. Okay. So deferred tax can be an asset or a liability, and it depends what it relates to. Now, because accountants are operating on the accrual system, we have to record this deferred tax. We have to create an account and say, there's a deferred tax liability. I'm paying less tax in year 1, but I'm going to, in the future, in year 5, I'm going to pay more tax. So I need to record this liability. I need to account for this liability, right? And obviously the same, if we paid more tax in year 1, we'll say, I need to record this deferred tax asset. I need to make sure that I accrue for this deferred tax asset. So because of the accrual system, we have to record whether we have a deferred tax asset or a deferred tax liability. Now, for back to 100, I don't need you to know how to calculate deferred tax, right? I'm not going to ask you to learn how to calculate deferred tax. Instead, what you need to know is I will give you the movement, and I will tell you what the balance is. I need you to understand what to do with that movement, right? So now let's have a look at a situation where we have a deferred tax liability, right? And so if you have a look at the slide that's on screen now, right? So if you have a look at the slide that's on screen now, you'll see, okay, what do we know? We know that we have a deferred tax liability with an opening balance of 10,000 Rand. Okay, opening balance, 10,000 Rand. And then we have a closing balance of 14,000 Rand. Right. What has happened? What's happened? It's gotten bigger. It's increased, right? Yes, the liability has grown. Has it remained? Because remember also the other question we need to ask is, because deferred tax can be an asset or a liability. Has it remained a liability? Yes. Yes, it's remained a liability. Has it gotten bigger? Yes, it's gotten bigger. So if it's a liability, right, on which side, debit or credit, on which side will it increase? It will increase on the credit side. Right. So what is this journal entry going to look like? We know the first part of the journal entry, the credit leg, it's going to say credit deferred tax liability. How much? What amount? 4,000 Rand. Right? And so where does the debit go to? The debit goes to income tax expense. So now, again, like what I was telling you when we first started talking about tax, I told you everything you learned last year is all going to be a lie. And now I'm telling you that what we were learning so far about current tax payable, right, and the journal that we just passed in example 10, so this journal here, that's only half the equation. The other half of the equation is the deferred tax movement. Okay? The other half of the equation is the deferred tax movement. Now, the difference between whatever was current tax payable and the deferred tax movement is the amount that goes to profit and loss account, is the amount that goes to your statement of financial position. So this amount, right, the sum of or the product of the current tax payable and the deferred tax movement is what you're going to see on your income statement. So in your test and exam, I'm not going to ask you to calculate deferred tax. Instead, I will give you something like this. I'll tell you deferred tax has increased. It's a liability. It's gone from 10,000 to 14,000. What I need you to do is you're going to need to calculate current tax payable, right? So just like we did in example 10, current tax payable, and then you need to have this movement, right? Now, the important thing to understand is when a deferred tax liability increases, right? So when it grows, when it becomes bigger, that results in a debit to income tax expense. Can everyone see that, right? Because we credited deferred tax liability, now we're debiting the income tax expense, right? So that results in a debit, right? And that makes tax expense bigger. Everyone happy? Now, question. What happens if our liability gets smaller? So if it decreases, right? So if I said to you, maybe you had an opening balance of 10,000, but your closing balance is now 6,000. So it's decreased. It's decreased by 4,000 Rand. So what would you then do to the liability? Instead of having a journal entry on the credit side, you're now going to debit the deferred tax liability and you're going to credit your income tax expense. So let's have a look at what that looks like. All right. So in this example, we're saying that there's a decrease in the liability, right? The liability getting smaller. We debit deferred tax liability. We now credit our income tax expense account, right? So now can you see that in a situation where a deferred tax liability decreases, it actually decreases or makes smaller the income tax expense that we find or that goes to the income statement. Can you see that? Can you see how that works? Right? Everyone understand? Okay? Okay. Now, just tell me if you lost or you don't understand so that I know where you're at. But if you understand, then good. The other thing I wanted to talk to you about is in this example, we only dealt with what? We only dealt with a deferred tax liability. Now, you know that deferred tax can either be a liability or an asset, right? So what is your job going to be? You're going to be required to look at what happens when a deferred tax asset increases. just a hint between you and I, when a deferred tax asset increases, it's the same as when a deferred tax liability decreases, right? And then you're also going to have to look at what happens when a deferred tax asset decreases, right? And then again, a hint is that is the same as when a deferred tax liability increases. Okay, but then the other thing that you have to do, the third thing, is you have to look at what happens when we move from a deferred tax asset to a deferred tax liability, or from a deferred tax liability to a deferred tax asset. So that is going to be your homework. That's what I want you to do on your own. Okay, now, guys, so far we've been discussing how to calculate tax, and then I've also been telling you about deferred tax. But what we haven't spent enough time talking about is our relationship. You see, I was watching a series the other day, and an actor said to another actor, "We need to have an RDC." An RDC. And I said, "What is an RDC?" And then I Googled it, and then it was a relationship defining conversation. Right. So now we are going to be having a relationship defining conversation between us and SARS. Right. What happens between us and SARS? Right. And so what I've done is I've created a 8-step program, like um, in the AA, in Alcoholics Anonymous, you have a 12-step program. We have an 8-step program to rehabilitate ourselves so that we become friends with SARS, right? And we'll talk about that program now. So the first thing is that you need to know is that SARS works on a 2-payment system. They call those payments provisional payments, right? Because, and we'll get to it now, we'll get to why they call it provisional payments, but it's a 2-step program. It's a 2-payment program that we need, that every company has to comply with, right? And so they basically say the first payment has to be no later than 6 months into the year. Now, each company has a different year end. So for each company, that will be a different date, right? 6 months into the year. But before you reach the half year mark in your financial year, you have to pay SARS. And they want you to pay them 50% of the amount you think you owe for tax, right? And they do that for a number of reasons. Number one is cash flow, so that the government constantly has cash, but it's also because they know that South Africans are very bad at pay debts. So if we leave everything till the end of the year, the company is not going to have any money and SARS will not get paid. So therefore, they want you to make payments basically halfway through the year, and then the next payment that you have to make is, that's called the second provisional payment, is going to be before your year end, right? So on or before your year end. So whatever your year end date is, it needs to be on or before that date, needs to be your second payment, right? And that's a 2-step program. Now, what's the problem with the 2-step program? Right? So what are the issues with this 2-step program? Now, the first issue with the 2-step program is this, right? You're asking me to pay tax for the entire year, but I must pay my first payment 6 months through the year, and then my second payment before year end. So from the accountant's perspective, guys, from the accountant's perspective, he will never know what his profit is going to be 6 months into the year. He's never going to have an accurate estimate of what the whole year's profits are going to be 6 months through the year. And then, even on the year end date, so on the last date of the year, he's not going to know then either, right? What his payment, what his total accurate profit is going to be. Why? Because he doesn't know what sales are happening on that last day, right? Everyone understand, right? Everyone still with me? He doesn't know what sales are going to happen on the last day, which means what? Payment 1 is going to be an estimate, right? And payment 2 is also going to be an estimate. Okay, does everybody understand why payment 1 and 2 is an estimate? Right? Because 6 months to the year, he doesn't know what the profit is. And also on the last day of the year, he also, in fact, doesn't know what the profit is. Right? Because he still needs to calculate that last sale, that last sale will only happen at 5 o'clock in the afternoon. But he needs to pay SARS before then. Right? The bank closes at 3 o'clock. So he needs to pay SARS before then. So the problem with an estimate is you will never be able to estimate it accurately. So you might have a situation where you overestimate it or where you underestimate it. Okay, it's very, very, very rare that you're going to get the estimate 100% right on the head, like, on the dot. You're not. It's not going to happen. So you're going to have a situation where you can overestimate tax or underestimate tax, and we're going to talk about that just now. The next situation you can have is 6 months through the year, you think, yes, I'm going to make a taxable profit. I'm going to make a taxable profit. So you pay 50% of the tax that you think you're going to owe. And then even on the year date, even on the last day of the year, you think, oh, I'm definitely going to make a taxable profit. I'm definitely going to make a taxable profit. So you pay the second provisional payment. But what happens when you actually look at your income statement for the year after everything is said and done? You realize that you're going to make an accounting loss or a taxable loss, right? So you're going to have an assessed loss, right? So this is the second problem. The second problem is I've already paid you. I've already paid the tax man, but I'm actually making a loss. So actually the tax man should do what? He should pay me back, right? So there's two problems now with this relationship between us and SARS. There's two issues, right? And so now our 8-step program is going to try and resolve these issues. Right? So let's have a look at step one. So step one is us making the payments. All right, and you can see in bold there, I say what we do is in payment one, we estimate the amount of tax that we need to pay, and then we're going to multiply it by 50% because we need to pay half of the amount of tax that we need to pay in the first provisional payment, right? Then in the second provisional payment, we make another estimate of tax. Remember, I said even that will not be 100% accurate. We will make another estimate of tax. We'll subtract the first provisional payment, right? The amount that we've already paid. And whatever is the remainder, we'll pay that. Okay, so that's the second provisional payment. Now, how would we journalize that payment? Remember when we spoke about journal entries, we spoke about that creditor, we called it current tax payable, right? We would debit that because it's decreasing, and we would credit our bank again because our bank is decreasing, right? And remember, this journal entry needs to be passed twice during the year. It's going to be passed for provisional payment one, and then 6 months later for provisional payment two. So that's the first step. We need to make payments, right? And why are they called provisional payments? It's because it's an estimate. Because it's an estimate, and when something is provisional, it's not final, it's not 100%. So as a result, they call it provisional payments because it's an estimated payment, right? So what do we do next? What is step two? Step two is us going and calculating taxable income. So it's basically our tax computation, which we spent a lot of time working on, right, so far in this series of lectures. So we go and calculate our income tax, our taxable income, and then we multiply it by 28% to get our income tax expense, right? And then how do we journalize that? Now we've already passed this journal before. See, we increase income tax expense, and then we credit the current tax payable, right? So it's debit income tax, credit current tax payable. That's the journal entry that we spoke about. Yeah. So then step four is us now submitting this to SARS. Now SARS says, okay, I'll give you 6 months because I know you won't know your. See, so even SARS knows that we will not know our profit on year end, right? So on the last day of the year. So he says, I'll give you 6 months to submit this tax return. And the official word for it is an ITR 14, right? So it's a type of form that you submit to SARS. You do it via e-filing. Right. And so SARS says, okay, I'll give you 6 months to submit it. So you go off, you prepare the more accurate version of your income tax after you know all your profits, and then you submit this thing to SARS. Right. So that's step four. Step five is SARS' job. So SARS now goes, he takes your tax return, your IT-14, he looks at it and he either agrees with it or he disagrees with it. Right. And then he gives you his calculation. Now, his calculation that he does as the taxman, we call it a name, and it's called a tax assessment. So it's basically his calculation, the taxman's calculation of your tax expense, Okay, that's his calculation. So he gives that to you. And remember, he is the authority when it comes to tax. He will tell you how much to pay. Right. And so you can have a situation where you thought that you're going to pay a specific amount of tax, but when you got your assessment, you realized it's more. Right. So what you've done is you've underestimated tax. An underestimation of tax is called an under provision. You thought you're going to pay too little of it. Right. And so we now need to record this. The problem is that it took you 6 months to submit your tax return. Then the taxman spent about 3 to 5 months looking at your tax return. And so where are you now in your timeline? You are not in year one anymore, right? You're dealing with tax for year one, but you like 8 months into year two, right? So this is happening well after you've prepared your financial statements. So you can't now go and scratch out the tax expense on your financial statements and replace it by the new amount that SARS came up with. You can't do that, right? That's not how we do things. So what you now need to do is you need to pass a journal entry in year two for this underestimation or this under provision. So how would you do that? Because you under provided it, you thought you're going to pay too little, you need to increase tax. You do that by debiting tax, and then you credit the payable. So you're now owing more to SARS. You credit the current tax payable. Okay. Uh, in some situations, you might actually estimate that you need to pay more tax than you should, and that's called an over. So you overestimated. So you call that an over provision, and that journal entry will be swapped around. So now you try and decrease tax expense by crediting it, and then you decrease your creditor, right? Your SARS creditor, which we call current tax payable, and you debit it, right? Now, if you get it wrong, right? So if you estimate your tax wrong, SARS implements negative marking, right? So if you get your tax wrong, if you maybe say, "Oh, I thought I was going to pay 100 rand," and so that's what you came up with, but SARS says, "Oh, you actually were supposed to pay 150 rand," all right? So SARS will implement negative marking on you. What does that look like? That looks like a penalty. So SARS will say, because you underestimated, I'm going to give you a penalty. And then also because you didn't pay that amount, I'm going to charge you interest on the amount that's outstanding. Right. So SARS has negative marking. So how do we journalize the penalties and the interest? Well, the penalties and interest are both going to be an expense. So we would debit it. It will increase on the expense on the debit side. And then we're going to increase our payable, our current tax payable by crediting it. Okay. Everybody on track? Any questions? I can't see anything happening. All right. Now, the last thing is, let's say we have a situation where we underestimated our tax, right? So we have an under provision, right? SARS has charged us interest. That still means that we need to pay that amount that's outstanding. So we're going to have a third payment. Now, this is far into year two, but this payment relates to the tax for year one. This is now 9, 10 months into year two, but you are still paying the tax that relates to year one. And so, how would you journalize that payment? It's going to be very similar to the provisional tax journals, right? Where you debit or decrease the payable and you decrease your bank because the money is leaving your bank account. Now, remember we also spoke about the second issue, the second problem with the two payment system, and the second issue, the second problem is that you can have a situation where you pay tax thinking that you're going to make a taxable profit, but you actually make a taxable loss, right? So now SARS is not going to give you your taxable loss times 28%. He's not going to pay you income tax income, right? He's not paying you income tax income. Instead, he will return your provisional payments and he'll say, "Oh, you paid extra, take your money back, but I'm not paying you any more," right? Instead, he will give you an assessed loss, that credit that we spoke about at the beginning of the lecture. So if he were to give you back your provisional payments, that is called a refund, right? A SARS refund. How would we journalize that? It's going to be the opposite of a payment. So we're going to debit bank and credit the current tax receivable, or if we still have a payable, it would be the current tax payable. Right, remember this is a debtor, so it can actually be a debtor or creditor depending on how many losses we made in the past. Okay. Any questions? Does everybody understand what we've been talking? How does everybody understand the relationship between the company and SARS? Hmm? Okay, good. So, guys, just like we did with the assessed losses, we did the theory in the last lecture, and in this lecture, we did an example. We're going to do the same with the relationship with SARS, right? Or with the payment of tax. So, in this lecture, we did the theory. In the next lecture, we'll do the example. So, that's the end of